We have talked about turnover assessment today. Now I told you we have 3 types of assessments. Or 4 ways in which a taxpayer can be assessed for tax in our last class. You remember? Who can remind us? Weeks. Company income tax consultation. So I think we have 4 ways in which company can be assessed with tax. Number 1, tax on dividend. Talk of taxation on turnover. Talk of minimum tax. We'll talk about my last class. And you remember that my last class, I discussed this extensively and I discussed this extensively. So, and I said, who can remind us what we talked about on this two? My last class with you.
You said that for dividend, you said that after Finance Act 2019, that it will be exempted from tax where it is paid from retained earnings, franked investment income, and profit already exempted from tax, like provisions, like maybe profit from capital gains tax or and maybe pioneer legislation. Then you said distribution made by real estate investment companies to its shareholders from rental income too will be exempted from tax. Then you said that but before Finance Act 2019, where there is no total profit, the profit the total profit, but it is less from dividend. That is like maybe there was no total profit, but they declared dividend, then they will pay tax on that dividend. So that one was for dividend. Then for turnover, I think you said like when there is no accessible profit and maybe the profit is accessible but is less than expected, like less than what the agency expected the company to be able to make, they will charge it on the turnover based on a fair proportion. That's what it said.
Thank you. I think you need to come and start teaching after you are done. Thank you for recapping everything we said in the class. Or who was that?
Yes, sir, it was me, sir.
When we get to our last class, I want to see everybody's face. So I will tell you the day that will be. I want to see everybody's face. You know, some of you are not using your picture or your profile. So everybody will display their picture. We will see each other in our last class. But I will let you know when that will be. Not now, for sure. Because I know some of you have not even had your bath. You just woke up. Okay. So that was what we discussed. Thank you, Sheyi. And I'm very sure every other person in this class can also remember that discussion. I think we also discussed minimum tax. If you have not discussed it, let's discuss it. When will minimum tax arise? Minimum tax will arise in a situation where there is no total profit. Number two, the company's income tax is less than the minimum tax computed. Or where the results or profits of the company results into no tax payable. Now, what do we mean by minimum tax? I said minimum tax will arise in a situation where the following occur. Number one, the company does not have a total profit. Number two, the company has computed company income tax and give them 5 million, for example. When we compute our minimum tax, we have 10 million. Which one will the tax authority take? 10 million. I also said where the result of the company results into no tax payable. What does that mean? When we say result of the company return result into no tax payable, what we are simply trying to say is that this company probably they had their all their profits are exempted from tax by the nature of what they do under the Company Income Tax Act. If a real estate investment company redistributes its income to its shareholder within 12 months, redistribute at least 75% of its income to the shareholder within 12 months of receiving the income, such an amount is exempted from tax. Imagine that that is the only income the company has. And after they have incurred expenses, because they know the provision of the law, they quickly redistribute their income to the shareholder within the specified period. Now, after they have done that, that means their profits will be exempted from tax. Now, if their profits are exempted from tax, that means they will not be taxed, right? And that is where minimum tax shows up. The next one is the first one I talked about. Let me explain it very well. When a company makes loss, okay, a company makes loss, and those that company makes will not make them pay tax. I mean, because they have made loss. So if a company makes loss, we know after that they will not pay tax, right? Now, because we know that they will not pay tax, that means we need to check for minimum tax. The next one is where the turnover of the company is more than 25 million. When the turnover of the company is more than 25 million, minimum tax will become applicable. What do you mean by that? A company with a turnover of less than 25 million under the Finance Act is regarded as a small company. is regarded as what? A small company. Why? Because the Act already specified the category of companies we have. We have a small company with zero tax rates, medium company with 20, and large company with 30. So we are saying that if a turnover of a company cannot carry the loan, or after they have given him, they cannot pay back, then that means the taxpayer will not be able to what? Will not be able to tax. So I'm saying 25 million is their threshold for small company. And the answer is a company that has 0 to 25 million is exempted from tax. So that means this company will not be what? Be paying minimum tax. But if it is more than this, they will pay a minimum tax according to the law. Okay? Do you have any question? Now, if there's no question, we'll move on to the next
Sorry,
one.
I have a about this 5 million. A small company ends up maybe in 2020, they now start making a turnover of 25 million. But maybe in 2025, their turnover started reducing and they started making like maybe 20 million instead. And from then on, will they still be classified as small company or large, or only for that year that they made 25 million that they will be able to pay only minimum tax?
When a company does not make a turnover of 25 million and above, the company is a small company. So they can now move from a small company. Okay. So during the medium size operation, they will be subject to minimum tax. If they fall back to small company, they will be exempted from minimum tax. Do you understand?
Yes, sir. Thank you, sir.
Good. Now, having said that, we move on to the next one. What are the companies exempted from minimum tax? Oh, number one company exempted from minimum tax is company within first 4 years of operation. So company within the first 4 years of its operation is exempted from minimum tax. Okay. Number two, company in the agricultural is exempted from tax. Companies with a turnover of less These are the companies exempted from tax. So when I say from tax now, I mean from minimum tax. Do you understand? Why do we charge minimum tax? I have explained it to you. Because the company says I do not make profits, then we test minimum tax. So how do we calculate minimum tax? Minimum tax shall be calculated at 0.5% of turnover less what is our frank investment? So, hope this trade is not affecting our class. Are you hearing it in my background?
I can hear you fine, sir.
Well, okay, there's no issue. Okay. I just wanted to be sure. Okay, so that's how to calculate minimum tax. In during the Finance Act, during the 2019 and 2020, we had COVID, right? So there was a reduced minimum tax rate for an accounting period that runs from 1st of January 2019 to 31st December. And the reduced minimum tax rate was 0. Frank investment. So that is that. So, but when we are talking about minimum tax, what is turnover or gross turnover? This is so we are saying when you talk about gross turnover, we said this is the inflow from business, which includes income from ordinary course of business, investment income such as rent, royalty, interest, and dividend, and any other income attributable to the business. Maybe there is profit on the use of fixed assets. It's also part of the income of the company. So let's look at an illustration and we move on to the next one. Do you have any question?
I have a question, sir.
Go ahead, please.
So you know the turnover in a business does not translate to the cash in the business that belongs to the entity. Now, for instance, if we are to calculate minimum tax, and that is what is to be charged on a company, and then the turnover at the end of the day, the minimum tax is even above the cash that the business owns. How does the business intend to pay such tax?
I don't understand.
Okay, this is it. Let's say turnover is 100, let's say 1 billion, for instance, and then we have to calculate minimum tax of 0.5% of that turnover. Okay, let's say the 0.5% of the 1 billion is around, let's say, 50 million naira in minimum tax. But the business, of course, it's a loss-making business, but the minimum tax was calculated as 50 million naira. Now,
Yeah.
what if the cash reserve of the business, the cash reserve of the business, that is the cash in the business that belongs to the business, not customers' money, is, let's say, 2 million naira? How does such business intend to pay a 50 million naira minimum tax based on the fact that it was calculated on the turnover of the business?
My brother, every business in Nigeria knows how to manage their funds. So the fact that a company is reporting loss does not necessarily mean that they have made loss.
Mm.
A lot of companies do that. They will show that they have made loss. So the respite from government is to say, okay, what is your turnover? Your turnover for that year, 10 billion, and you have recorded loss. Okay. Give me 0.5% of your 10 billion, which is about 50 million or 500 million. For that company that is doing that magnitude, 50 million or 500 million is not a big money to them. They will pay it. Because you were to make profits, they will be paying nothing less than maybe 3 billion or 4 billion as a profit. If they are making a turnover of about 50 billion, let's say, for example, you don't be paying less than 5 billion as a profit, as a tax.
Okay.
You want to tell me that because if you acquire an asset, that the asset that you acquire, you are not bringing it to your P&L. Do you understand?
Yes, true.
So you are not
Yes.
bringing it to P&L. You are only bringing the portion of it as your capital allowance, maybe 25% of that in the first year.
Yes.
That's the maximum you can relieve against it. So at the end of the day,
Is it my network? Oh
Turnover.
Lord.
We have 25 million. The tax authority will select the tax of 25 million, my brother. Because that will give
Okay.
them rest of mind.
Okay.
Okay. If you have my textbook, good. If you do not have, no problem. We must have put some questions in the study pack, but my hand cannot get there now. So, Mr. Hussein, are you with your book?
Yes, sir.
Go to where you have minimum tax, illustration 3.
Okay.
Minimum tax in chapter 10.
Chapter 10. Do 5. It's on the, that's how I'm on the page. Which page? But the question, is it question 1? Jibala.
Question 3.
Okay, question 3. Okay, I'm there, sir.
Please, snap the question and send to the class.
Okay, sir.
Yes.
Where are you for us?
The following information was extracted from the statement of profit or loss of ABC Limited. I don't have to read all this. Turnover profit from discontinued operations, profit from other non-core operating activities, rent received gross, dividend received from XYZ Limited gross. Notes to the account were further disclosed in the following information. Revenue from discontinued operations, less expenses on discontinued operations, and total profit from discontinued operations. Revenue from other non-core operating activities, less expenses, and profit from non-core operating activities. Required, compute the minimum tax of the company.
Okay. So, what do we do in this question? The first thing in this question is to get our turnover. Okay? Well, examiner deliberately put for us profits from discontinued business, profit from non-other core business. Why did the examiner do that? The examiner want to convince you or confuse you. We really want to take that as your revenue. It is revenue we are talking about. Okay? And you remember I told you from the ordinary course of business and every other source of business, including investment, right? Now, when you look at that, you will see that our turnover, we need to calculate this minimum tax. In calculating minimum tax, we need turnover, right? So the first thing, turnover from main business. How much is that from main business? 20 million. Next, turnover from non-core business, from discontinued business. How much are turnover from discontinued business? That is 3 million. Turnover from non-core. How much is that?
5 million.
Yeah, so we now receive some investment income, rents. How many are rents? How much is the rent?
1 million.
Dividend. How many are
Dividend. 2 million.
what else? That's all. Abi?
Yes.
This is our gross investment.
$31 million.
That's 1 million. Remember I said dogs, investment income. How much?
2 million.
Balance.
29 million.
So, minimum tax now. What's our minimum tax? 25% of 29 million.
$445,000.
So that is the minimum tax. We have a question.
Yeah, that side where you wrote deduct. What did you write beside it, sir?
Which one?
The where you wrote deduct. What?
Frank investment income. Frank
Oh,
investment. So we now say, Mr. Christopher, you know definitely that dividend is not supposed to be there. So why you put it as part of gross? But that is the definition of gross turnover. So I will not remove it from. You know we are still going to remove Frank investment income. We will say I don't know. We have it. Any question? Okay. We are still going to see more minimum tax question in the future. as we go ahead. So that is now. The next one is total profit. We are going to dwell more on this aspect. We'll dwell more here. Now, for total profits, what do we mean? This is the computation of tax and profits made during the fiscal year. You remember that when I told you that filing of return, one of the things I told you is that the taxpayer must file the returns, are we? Or is not going to file is the annual return. Yes. So the total profit is computed is a computation of total profits or made during the year. So how do we calculate that? You remember we have done the concept of adjusted profits. We'll start from there. Adjusted profits. Adjusted profits is the same thing as accessible profits. Okay? So if we have balancing charge, we will bring this in. Sorry. So balancing charge will be gotten from disposal of assets. Will be gotten from disposal of charging assets. So the first thing will be to say loss to the brought forward, ready for the year, and carry forward. Then you have that profit. Honor this one. At 10% or 20%. So 30% or 20% of the total profits. We use this tertiary education tax will be 3.5% of the accessible bonus. Okay. So if that is the case, we know that for every other one, it is a straightforward one. But examiner usually tests from this perspective very well. So we need to understand this clearly. Let's go. Now let's talk about companies, types of company. Basically, there are three types of company. We have the small company, we have the medium-sized company, we have large company. What makes a company a small company is their turnover, 0 to 25 million. Above 25 million, size company. $100 million above. So they must understand this type of company when you are solving questions, because that is where you will know the applicable rates, tax rates applicable. Now, in my last class, we were discussing benefit for early payment of tax. So what is the benefit? 0%. 2%. 1%. This is on 19 months. So
Sorry, there was for me. Is this benefit for?
payment of tax early.
Oh, thank you, sir.
So if you pay your tax within 60 days, as against 90 days after filing, we said you are going to get the benefit of 1% if you're a large company. If you're a medium-sized company, you will get 2%. Meanwhile, if you are a small company, you get 0%. So no stress. Now, another thing that is very important for us to know is to know the tax implication of expense of income can tell us that. So if I incur an expenses, so and I use it in deriving tax exempt income, will the expenses be aligned with reduction or not? Will it be exempted from tax or not? So it will be exempted. So when a company, when a company incurs an expenses in deriving an income that is exempted from tax, such expenses shall be disallowed. Such expenses are exempted. So if you incur that expenses to generate tax exempt income, such expenses will not be allowed with reduction. Imagine you have 100 million. Out of this 100 million of your income, 70% was legitimate income, 30% has one thing or other to do with exempted income. The only portion that will be taxed, that will be taxable, is 70%, while the only portion that can be removed as not allowable is 30% of it. So let's look at our illustration. Illustration. I have the illustration. Let's look for it. Write this illustration down. Complain XYZ cured 100 or 200 deductible stop in generating generating business profits of I said company XY Limited incurred 200,000 in generating business profit of 1 million. Sorry, 1 million. In the year ended 31st December 2023. You were informed that only the sum of 700,000 of the amount of the total business profit is accessible for tax, while the remaining $300K is tax exempt. So the question is how much of the expenses be allowed. So let me see if you get the question right. Company XYZ Limited incurred 200,000 deductible expenses in generating a business profit of 1 million. Are we there? In the year of the 31st December 2023, you were informed that only the 700K out of volume of business profit, is accessible to tax, meaning to tax the remaining. Sorry. You were informed that only 700,000 of total business expenses is accessible to tax, while the remaining 300,000 is tax exempt. How much of the expenses will be allowable for tax? Now, firstly, they told us that the total expenses incurred by this company is how much? 200,000. Now, this 200,000, they told us that the income made by the company is 1 million. This income made by this company, 700,000 of that is accessible income tax, and 300 of that is exempted. So you remember, we said any expense incurred in generating tax exempt income will not be allowable deduction. Now we are now being asked for us to get out of this 200K, the portion that will be allowed, because definitely the 200 million generated, the 200 million generated 1 million, right? But this 1 million, we have given another information on it that 700 out of that 1 million is for business, is allowed. 300 is tax exempt, that is, they will not tax. So we're now saying, let's get the portion of the expenses that will be allowable, the portion of the expenses that will not be allowable. Now, how do we get that? Now, the only solution to this is to say, what is my proportion of income against my expenses? So I would say, for the one that will be allowable, we told 700 is allowable, I'll multiply it by 200. This portion is allowable. The one they said is not allowable. So this guy will be 140. This guy will be 60,000. So out of this, you remember we're told that this 700K is accessible to tax. Abi? So any expense you incur in generating that will be allowed, Abi? Now in getting that, we said let's get the total expenses. Title is 200. So this 140 will be allowed, and this 600 will not be allowed. Any question, please? Any
Sir,
question?
sorry, I'm confused. After the diagram, what does the 140,000 indicate?
This 140,000, the total expenses is 200K. The 200K was used in determining or in generating 1 million. Abi? But you remember the principle says that any expenses you incur in generating tax exempt income is exempted. But we do not know the portion of the tax expenses you incur in generating the 300. We do not also know the expenses incurred generating the 700. But we shall know that we generated 1 million. But in this 1 million, we have 700K that is taxable. We also have 300K that is not taxable. So for us to get the allowable portion of the expenses, allowable portion. So what do? Is to take the proportion of the taxable income, which is 700, divided by the entire 1 million, and multiply by 200, that is the entire expenses. To know the portion of that expenses that will be allowable to you and the portion that will not be allowable. Okay? Now, the portion that will be allowable to you is 700K. Meanwhile, the portion that will not be allowable to you is 60K. Why is it 60K? They told you in the question that 300K is tax exempt. So any expense you incur in generating this 300K is exempted from tax. Any question?
Okay, so I wanted to clarify what we are working with is that the tax implication of expense used in deriving tax exempt income is
Yes.
disallowed.
Yes.
Thank you, sir.
Okay. Let's talk about business reorganization and restructuring. tax application of business business reorganization. So when you talk about business reorganization and restructuring, this means that a business is sold to a Nigerian company for a better reorganization and management. This will arise where the assets placed or business being carried by. That's again. So what is business organization and restructuring? We say this will arise where the assets from our business or trade being carried on, being carried on by a company is transferred to another company for better organization and restructuring. For better organization and what? Restructuring. Now, in transferring or selling your business to another company, the following conditions must be fulfilled. Conditions before you make transfer. Number one, the parties involved must seek FIRS consent. Consent. Spell consent.
CONSENT.
That is, they must be aware. Number two, there must be prove there must be control by another company. So let's put it, I just want to summarize it. There must be connection. There must be connection between the company transferring the assets or business to another. There must be what? There must be connection between the company transferring the asset of another company. They must be connected. And this connection, the connection must not be less than 365 days before the transfer took place. Let's go again. These are the conditions. Number one, the first condition is that you must seek FIRS concurrence. Number two, there must be connection between the company transferring the assets or business to the other company. There must be connection to the other company. And this connection must have existed for at least 1 year before the transaction took place. There was a connection between the company transferring the assets or business to the other company. And the connection must be what? Must have existed for nothing less than 365 days or 1 year before the event takes over or took over. Now, the next one that is very important. Now, if you are able to meet up with these conditions, there are concessions for business reorganization and restructuring. Provided they follow all these conditions up there, value added tax shall not be applicable to the transfer or sales. Number next. Capital gains tax. Shall not be applicable also. You can see that the concessions are good. Number next. Commencement rule. And cessation rule shall not be applicable. You guys have done tax implication of merger and acquisition, right? Have you? Yes. Cyrus has taught you.
Taught us what, sir?
Tax implication of merger and acquisition.
I have no, I don't know, or maybe I was not
He
around
has,
that time.
he
But
has done that.
Yes,
He has
yes,
done
he
that.
has done that.
You remember that when a company is taken over by another company, right? The commencement rule will be applicable to the new one that is just being formed, while the one that is being closed will
We do
apply
cessation.
cessation rule. Now, I want you to keep this in mind, this diet. And the reason why I'm saying this again is because of the bank consolidation that is ongoing. Bank consolidation that is ongoing. The tax authority we have, so I said the tax authority. The examiner might likely ask you question on all these things. The examiner might likely ask you question on all this. So you need to be very conversant with what is happening in your environment. So for business organization and restructuring, when they follow this principle or conditions, value-added tax will not be applicable to them, capital gains tax will not be applicable, and commencement rule and cessation rule will not be applicable as well. But if they fail to follow the rule, what happens? All the concession will be withdrawn. Okay? All the concession will be withdrawn, and the liability will also arise. Now, the taxpayer can only transfer the assets to another company after 1 year of the transaction. I get what I'm saying. So that means within 1 year of the transaction, you cannot transfer the assets. If you do such, you will be liable to penalty. The next one I will talk about is tax implication of a reconstituted company. What is a reconstituted company? A reconstituted company is a company that is being carried on by a foreign entity. A reconstituted company is a company that is formally operated by a foreign company eventually transferred to okay. So it's a foreign company that was managing it before, but eventually got transferred to a Nigerian company. Got transferred to a Nigerian company. So we'll say it is what? It is a constituted company. Now, for a constituted company, such a company also has this kind of provision that is similar to this company, that is similar to a organized company. They also have the same provision. They have similar conditions. And we're going to look at the conditions now. Now, for a constituted company, number one condition is that conditions for the company to get some waivers. Number one condition is that FIRS must be aware of the transfer. FIRS consent is very important. FIRS consent is important. Number two, FIRS must be satisfied that the business to be carried on by the constituted company is not materially different from the foreign company. Not materially different. So the nature of their business must be the same. It must not be what? Different. Okay. So if these conditions are met, the following concession will also come. Number one concession. Commencement rule and situation rule will not be applicable. Number two, assets. Be taken over at tax using noun value. The constituted company are allowed to recover the previous losses from the previous losses incurred by the foreign okay. So they will be allowed to recover the loss of the company that is a foreign company, the loss they incurred, or relieved loss, they will be allowed. The next one is that they would take over the asset at their tax nominal value. Asset will take over tax nominal value. By implication, you can continue to use the assets of the foreign company. In terms of calculating annual allowance, we will only calculate on the useful life of the asset. And the next one is that commencement rule and cessation rule will not be applicable to the company. So that is that. The next one, so that when we come in our next class, we'll not be talking about all this theory again. Someone should use that. It will limit your mind. So the next one we are going to be looking at is tax implication of interest deductibility into. Are you with me? Within the next 20 minutes, we should be out of here, 15 minutes. Now, when we talk about interest deductibility rule, this is talking about, Mr. Idris will have taught you what we call tin capitalization. Abi, under your tax planning, you would have spoken about this. Abi, what is tin capitalization?
That's what we'll do next.
That's what you will do next. Okay, thank you. So when you talk about tin capitalization would occur, this will occur, or is a situation, let's say the situation not will occur, is a situation where the company is highly geared. When we say company is highly geared, what does that mean?
On debt, highly on debt.
That is, the company is mainly financed by debt. Now, if the company is mainly financed by debt, we all know that interest on loan is tax deductible. Yesterday, mute your mic. And Emmanuel, you should put your mic. We all know that interest on loan is tax deductible. So some companies go as far as obtaining loan from their foreign counterparts. From their foreign counterparts. So that they can what? Take advantage of this foreign, of the interest on loan. So we could also see this as a form of transfer pricing. We could also see this as a form of base profits, base erosion and profit shifting to the other jurisdiction. Okay? Or we could also see it as a way of a tax authority or tax, a way a taxpayer is trying to manage his tax affair in such a way that he doesn't want to pay tax. He doesn't want to pay tax liability. And you know when you talk about tax haven, so when you talk about tax haven, you know that we said a tax haven is a jurisdiction where there is no tax paid at all, or they have a lower tax regime, no payment of tax or a lower tax regime. So imagine if a company in Nigeria, for example, obtains a loan in a country with a low tax jurisdiction, and pay the interest on loan back to that country or to that company in that region. By implication, it means that you are taking income away from Nigeria and you are going to another country to obtain what we call tax benefit, reduced tax benefit. Therefore, the government now says, okay, if that is the case, we are not saying you should not obtain loan to run your business. But going forward, according to Finance Act 2019, Samuel, you are welcome to the class. According to Finance Act 2019, the Finance Act 2019 says that your interest on loan to be allowed in a particular year shall not be more than 30% of your earnings before interest, tax, depreciation, and amortization. Now, where in a particular year your interest on loan exceed the 30% of EBITDA threshold comma, the excess can be carried forward for a maximum period of 5 years. The maximum period of 5 years. So that means at every point in time, you must check 30% of your 30% of your earnings before interest, tax, depreciation, and amortization to check if the interest or loan in the question is not more than that. If it is more, you have to disallow it. You disallow the excess. The excess should be disallowed. Do you understand? So that is what the implication of this tax, interest or tax deductibility is saying. So your maximum shall be 30% of your earnings before interest, tax, depreciation, and amortization. Okay. Let's put some other things in the class. Let's really talk about donation. Basically, we have two types of donation I'm going to be looking at. We have the regular donation, and we have donation during pandemic or exigencies. Now, donation is done at a rate of 10% of total profits for this donation, the regular donation. And for regular donation, we said it is not more than 10% of your total profits. And donation cannot be made out of loss. Donation cannot be made by a company out of loss. That is, a company that is making loss cannot donate, and donation cannot be in capital nature. Okay? We'll talk about this later. So, donation cannot be what? In capital nature, right? Can be in capital nature. Now, the donation can be capital in nature if it is made to tertiary institution or research and development institution. So if it is made to university, you can make it the capital nature. But ordinarily, companies should not make donation of capital nature. And this donation that we said is usually 10% can be increased to 15% if it is to tertiary if to tertiary institution or research and development institution, 2% of their total profits. So that is that. Now we now talk about donation by a company during exigency. During pandemic or exigencies. Now, what does that say? You could make donation in cash or in kind. That is by manufacturing items and donate to the fund established by government. So now, what is the maximum? So you can donation of 10% of accessible profit. 10% of accessible profits can be donated, okay, to the tax authority, or sorry, to the companies or to government rather. Now you remember during the COVID, some banks donated 1 billion. I remember Access Bank donated 1 billion. Union UBA 1 billion. All the banks were just giving government money during the COVID. So all those money that were being donated, right, are for this purpose. And because they are for this purpose, they are going to be allowable expenses. They will be allowable expenses, right? Now, the Act is also saying that this donation must be, because we have said it is maximum of 10% of your accessible profits. So where the amount donated by the company exceed the 10% allowable by the Act, the excess can only be carried forward for a maximum period of 2 years, after which it will become lapsed. So that is that. Do you have any question for me? So all these things that we are writing in class, they are also in your notes in the study pack we sent to you. So this class is just for summary of the study pack. I don't want to be going through the study pack and be reading as we are written. Do you understand me? So this is showing the understanding of the person teaching you. Okay, so you need to also go through your study pack, understand it, combine it with what we have done in class, and you'll be good. Do you have any question for me before we go? So when we meet in the next class, we'll start our calculation. By next week, by the grace of God, next week is what? What date is next week?
20.
20. I might need to teach you during the week, this coming week. Governor, who is your governor in this class?
Minister of Finance.
Minister of Finance, where are you? What's his name? What's his name now?
Minister of Finance, and it seems he is not in the class today.
I've not been seeing that person in my class. Okay, so I won't be available on the 20th. So we need to do a makeup class before 20. So when is your free time? When is your free time?
Friday.
Wednesday and Friday.
Friday. We are not free on Wednesday. We have class on Wednesday. We don't have class on Fridays. On Mondays. On Mondays.
It's only
Only on Friday we don't have class.
Okay.
Monday we have strategic finance now.
Okay, so let's do Friday. Friday. What time should we start?
Okay, sir.
8:30. It's okay.
6:30.
8:30. 8:30.
8:30. Please, send me a reminder during the week so that we can fix the time.
8:30 is fine.
Okay. Thank you. We'll do 8:30. 8:30 p.m. on Friday. Okay? So let's have it that way. Thank you, guys. So when we come back 8:30, we are going to be doing past question. At least for that day, we will do minimum of 3 past questions from 2020 to 2025. We pick questions random. On 27, we round up company tax. And on the next class that we're going to be having in October will be hydrocarbon tax. Hydrocarbon tax. So, see you there. Please don't miss class, or I'm begging you. I know today's class is summer for me. At the beginning of the class, I was very tired, but we thank God we put through today. So that is how it's going to be. see you by next week Friday. Thank you, or God bless you.
Thank you, sir.
Thank you, sir. Well
Thank
done, sir.
All right.